We kicked off this hour talking about this debate that seems to be emerging in the markets right now about whether equities are actually getting ahead of reality, whether we could potentially see a retest of those March lows as some of the data, some of the earnings start to come in coming weeks. What is your assessment of the levels that we're trading at right now?
Well, thanks for having me. Look, in the first quarter, particularly in the second half, there was no shortage of opportunity in the market for a value investor like us at Oakmark. Just because we're long-term value investors does not mean that we can't be nimble and react quickly to opportunities. And there were lots of them in the second half. And I think when you look at panicky markets like we had, there's a lot of babies thrown out with the bathwater, and it's a great opportunity for us as portfolio managers to increase the quality and price of the portfolio for our clients. And because of this environment, we were unusually active in the first quarter. We just put out our quarterly report so I can discuss what we were doing. Just for an example, in the Oakmark Select Fund, which is a 20-stock portfolio, we added 4 new names in the quarter. That's unusual, but we had an unusual environment.
Absolutely. I'm curious what the babies that were thrown out with the bathwater are from your perspective. Where have you been finding value, especially given the fact that, and I realize the sell-off has been very broad in the last couple of weeks, but some of the hardest hit names have been some of those where revenue has literally dropped to near zero and where there is still such an uncertain path forward in terms of returning back to business and back to service.
Yeah, the names we bought were a mixture of things that I would say were down for no good reason and others that were down for good reason. And kind of addressing your exact point on businesses where revenues drop more dramatically, one of the names we added in the quarter was Booking Holdings, which is the largest online travel agency. Now, Booking is going to go from making about $100 a share for a $1,400 stock to potentially losing money this year. But they have a terrific balance sheet. They have a flexible cost structure, a great management team, and we think they've got a long runway, whether this is U-shaped or V-shaped, to make it to the other side with value intact. And I wouldn't be surprised to see earnings of $120 a share on a cash basis in a couple of years. That puts the stock at 11 times that number, which is far too cheap for a company of this quality.
Some of the names that have also done amazingly well this week are names that have futures that seem equally endangered. Retail, Kohl's, Nordstrom. I wonder what your take is on the run those have had. And then conversely, the stay-at-home names that have been rallying for a month now, how much danger is them on the downside if, in fact, even if we get a return to semi-normal life, how much is already embedded in those multiples?
Yeah, so here's a stay-at-home name we actually ended up buying in the first quarter. Constellation Brands, beer company, key brands are Corona and Modelo. They're in the unfortunate position of having a global pandemic with the same name as one of their key brands, right? But when looking at the recent results, they seem to be holding up well. We think we're buying this looking out a couple of years at around 10 times normalized earnings. They're still growing their beer volumes 8 to 10 times the rate of the beer industry at large. So it's a terrific franchise that, again, while it's a more stable demand structure, we think the market got way ahead of itself selling it off because of COVID.
I realize that they haven't been trading exactly lockstep, but when you look at the moves that have taken place, the correlation between equities and crude oil, certainly we saw it yesterday, that reversal, that 3.6% reversal in the S&P moved lower as crude prices moved lower. Even today, we're seeing energy, the best performing sector in the S&P again, as prices in the crude market are higher. Is there value to be had in that sector, or is it just too volatile, too uncertain, too beaten down, given everything we're seeing play out with this price war on a global basis?
Well, we do own energy. We do think it's investable. We did use the first quarter as an opportunity to upgrade our energy portfolio, as well as take a tax loss for clients. So we added EOG Resources, which is a diversified U.S. E&P producer with best-in-class management and best-in-class balance sheet. And when you have markets like we had in a sector as beat up as energy, even companies as good as EOG, which are not cheap often, are cheap. And cheap enough for a value investor like Oakmark that has very high standards for both management, quality of business, and undervaluation. And EOG fit the bill in the first quarter. So we were excited to be able to add it to the portfolio.